Hey guys, and welcome back to another episode of Speaking Logically. My name is Scott McKenna, and today I'm joined by Michael Gennawey, who's the financial advisor and program manager at SoCal Wealth Management. Michael, how are you today?
Great, Scott. Thanks for having me on.
Yeah, great to have you on. So, Michael, I know you've been talking to some of my colleagues about our Logically platform, and we chatted a little bit before, but super interesting background. Would love for you to tell a little bit to our listeners about you and your business over at SoCal Wealth Management.
Yeah, so we are a full-service wealth management financial planning firm. We're on the LPL platform, and we're affiliated with the Credit Union of Southern California. So the majority of our business is working with people, members of the credit union, we call them, and mostly everyday people, business owners, employees, families. We do a lot of that. And we have about 4 financial advisors, 1 junior, and 2 assistants.
So awesome. So tell me a little bit more about how that works, being part of LPL and a credit union. Most of the other advisors I don't think we've actually talked to anyone who is accredited with a credit union. Would you mind explaining a little bit more, how that works with your business?
Yeah, because it is a little different. So instead of it being like an RIA where we are outside and have to earn business from the community, we have members that are working with this credit union. In my particular case, Credit Union of Southern California, there is 120,000 members. So when it goes to marketing, we already have like a captive audience to work with. And a lot of times they come to us when they need retirement planning or college funding planning, or basically in general, try and game plan for what they need for their financial future.
Awesome. And so what are some of the unique challenges that you face being associated with the credit union?
Yeah, so the best part is, in terms of like building up the business, we have that captive audience. So we know who our demographic is. The tough part is, since we are working with everyone at the credit union, you have to be well versed in just about everything, because someone who's starting out and investing and their profile and what they need is going to be a lot different than someone who's been, at a company for 35 years and about to retire and has a lot more different amount of needs. So that's the biggest challenge. You have to be well versed in everything.
Yeah, awesome. And when it comes down to your day-to-day, what does that look like? Are you mainly working on, portfolios? Is it a lot of financial planning? Curious, what's the breakdown of your activities that you're going through, every single day?
Yeah, and my role has changed over the years. I've been with SoCal Wealth Management for 11 years now, and it started off being primarily financial advisor, but at this point, maybe about half my time to 60% of my time is financial advisor, and the other 40% of the time is mixed between management of the program and the other advisors and portfolio construction. So one of the things I didn't mention earlier is that I am the portfolio construction. I do all the construction of the portfolios for the team. I do run all the models.
That's awesome. We love to hear that. And that's why you were looking at the Logically platform, right? So
exactly. Mm-hmm.
I would love to hear, what's your process when you're constructing portfolios? We can start off with that, and then I have a couple more questions to follow up off of that.
Yeah, so, and once again, that's evolved over time, but the way it stands right now is I have a tech stack that I use to vet and re-vet the positions I have in the different models. So I run about 10 different models with 5 different risk profiles, and I do a tax-sensitive version of each of those 5. And what I'll do is, I don't have a set schedule in terms of like calendar of when I do it, but basically 2 to 4 times a year, I'll sit down and really make sure I have the best pieces, because as we know, with ETFs and fund companies, they're always innovating. New things are coming out, and if you're using the same ETF or fund you've been using in the last decade, it might not be the most appropriate going forward. So what I do is I make sure that the models are appropriate, not just with rear view mirror analytics, but also forward looking as well.
That's awesome. And you mentioned, the fact that you're the fact that you're swapping out different ETFs. How do you choose which ETFs go into your portfolios? Because I know it can sometimes be a daunting task. There's over 2,300 in the US. If you're looking at it globally, it's like 9,800, right? So what's your process that you go through to kind of screen for them?
It depends on what part of the portfolio. So if it's like fixed income, I'm obviously looking at things like risk metrics. I'm looking at yield. I'm looking at liquidity. When I'm looking on the growth side of the portfolio, obviously a lot of that's going to be equity. So I screen for different things there. I also make formal allocations to satellites and hedged investments as well. So I know a lot of buffer products are coming out in the ETF space. Those have been great for my more conservative clients. So that's helped to refine those portfolios to, especially with the COVID crash we had in March of 2020, earlier this year. The risk metrics on those did fantastic. So by screening those different categories, made it a lot easier to find the right products.
Awesome, yeah. And talking about the buffered ETFs, that's interesting that you brought that up. We've also been keeping an eye on them. And also, I'm curious your thoughts on the products that are semi-transparent as well.
Yeah. So, starting on the first one, and it's always going to come down to the allocator to know their clientele, right? So my clients a lot of times skew more conservative, and they're willing to give up that upside and maybe have a slightly higher expense ratio, knowing that they're going to have some protection in down market. So it's not just the buffer ETFs, but also the smart beta suites. Minimum volatility ETFs have been fantastic this year as well. So in terms of the risk mitigation that they've provided. So on that side, I am open to all those different types of products because they exist for a reason. They fill a certain niche, and if it's appropriate for your client, they do a great job. And then on the semi-transparent note, I'm somewhat reluctant to it at this point, but that's just me being more of a control freak than anything else. I like to know what's in the portfolios. We talked about what I screen for. If I'm ever on the Morningstar website, the first tab I always go to is the portfolio tab. I want to know what their holdings are. I want to know what weight they're being held in and how often that's being turned over. That's kind of like the first way I kind of gauge what an ETF or a fund is doing versus what they're trying to tell me they're doing.
Awesome. And you mentioned you were using Morningstar. What stood out to you when you were looking at our platform, the Logically platform?
Yeah, exactly. So in terms of like the amount of data I could get to quickly, Logically is fantastic. So one of this, we could walk through this one. So one of the ETFs I was using this year was a thematic ETF from a company called ARK Investment. And they have an ETF, or actually what I did is they have an ETF called ARKK, and they had a very heavy weight in Tesla this year, and they still do. It's one of the reasons why their performance has been so good year to date. And I wanted to see what other ETFs are also holding a similar weight. Is anyone else doing it? And if you use the stock to ETF tool, stock to ETF lookup, put in Tesla, and it's going to bring up basically, and you could sort by weight, the weight column. Yeah, it's going to show you who are the top companies doing this. And you can see ARK is one of the leaders there. So once again, when it comes to portfolio construction and vetting what companies I have in the portfolio, I could at least this way see, are there other companies I should be considering very easily? And that was something that I had a lot of trouble with before using the platform, before using the Logically platform.
Yeah. No, it's funny that you mentioned ARK, and it's actually not the one, because they were received for years and years. They received a lot of hate about that Tesla position, right? Because it was such a big weighting. and they've done an amazing job. The performance has been excellent, but it's funny you don't see these other ETFs. Well, EARK, that's Canadian, but these other two ones, IYK and XNTK,
Mhm.
they have a much larger position. I'm sure probably not as long going back as ARK, but still, it's interesting to see that because I would have thought for sure ARK would have had the highest position. So that's really
And
cool.
granted, it probably would have been the highest position if they weren't paring it back, but they are. They are trying to keep it at a certain level. So I get what they're doing there. And once again, that's something I could take into consideration. Maybe it's time to change into iShares or somewhere else, based on what my clients' needs are.
Yeah, definitely. And you mentioned before that a lot of what you do has to do with taxes, right? So did you have a chance to look at some of the tax stuff that we offer on the platform as well?
You know what? I haven't done so much of that, but if you want to walk through it, let's take a look.
Yeah, for sure. So there's really two well, the main tool here is in the analysis, portfolio analysis. So like you said, this is the first thing you go to ahead and look at.
Yeah.
Also, did you have a chance to do any of the integrations, or did you just kind of upload the CSV?
No, I was just doing that, a CSV file, because
Okay, cool.
another piece of software I uses a CSV file, so I already had it set.
Oh, cool. Awesome. Yeah. You can use, for those of you guys who are watching and interested, you can also use integrations. So we're working on getting into LPL, but right now you are able to use Plaid, which I'm sure you guys have used it if you ever use something like Mint or a lot of other things. So it basically aggregates the account data. We even do Robinhood. That's just what it comes with. So if you're an individual trader of this platform, you could use it as well if you're listening to the podcast. So I have my Chase account, which it's not logged in, but I'll load in. I did one SPY BND plus gold.
Okay.
So it's equal weighted, and I'm going to hit apply here. And so in this tax section, I know there's a lot of sections. Sometimes when we talk to people, they only get to look at it a couple different ones. What we do is called a tax loss analysis. So this is all up year to date, so not a good example. I'm going to switch this out for something that I know is down and is an absolutely crushed, which is XLE, right? Energy.
Sure.
I think last I checked, it was down like 40.
In terms of having too much data on the screen, it's kind of hard to do that. The fact that there's so many tabs just means I'm not clicking to other tabs on my web browser. So
that's true.
Not really a problem.
So here we go, down 50% year to date, XLE. So what we're actually doing is we're scanning the portfolio and we're identifying highly correlated rebalance trades that you could make and harvest the tax losses. So for you managing the portfolios for the other advisors, you can run this once a week or whatever using those CSV files. Or if we get it set up with feed, you can get notifications saying, XLE is down 50%. Here you go. You want to move, maybe you want to move out of it. And in this case, maybe VDE would be a better position. And hey, here's something else. You can save, a couple bips by switching from XLE. XLE is at 0.130 and this is 0.10 VDE. So you can go ahead and make that swap. Still get 99% correlation. And then the other key thing too, right, when you're thinking about tax loss analysis, avoiding that wash sale, right? So how are you currently thinking about avoiding the wash sale when you're making these trades, like where you're screening for ETFs? So obviously you can look for like correlation, but what are the other metrics that you're currently using when you're thinking about?
Well, a lot of the ETF providers I use right now are the big names, iShares, Invesco, State Street. So I kind of know where I can go to for a similar fund because they have such a huge offering. So I don't usually run into wash sale problems because I kind of know where to go from there. But the way that this is listing it out, and like you said, instead of trading, 2 to 4 times a year, having a weekly feed would be a huge advantage to take, especially with all the volatility that we have. If I could be a little bit more nimble with that, that would be a huge advantage. And yeah, in terms of screening for expense ratio, if it's the same benchmark that the ETF is using, as long as it's liquid, I don't need to go much further than that to make sure that it's going to be a good fit.
Yeah, that's true. We also went a little bit further, just so that, like, because originally when we set this up, I think some people were weary. They said, 99% correlation. How is that going to avoid the washout rule? Well, we said, all right, let's take it in a step further. And so we're looking at the underlying indexes as well. So what we're doing here is, XLE is in the S&P Energy Select Sector Index, right?
Mm-hmm.
So they have their own sectors, right?
Right.
And then these other ones, they're actually in different indexes. So in that case, they're constructed differently, and therefore, 9 times out of 10, we figured they'll probably be avoiding the washout rule. So, now again, IYE is following the Dow Jones Global United States Oil and Gas Industry Fund Index, and then VDE is following the MSCI Index. So another way just to make sure that you can avoid the washout rule, from what I've heard from other advisors, is they'll usually say, I'll look for a high correlation, but then I'm going to switch indexes, just to make sure that I avoid that washout.
Yeah, exactly. It's the same way to approach it, because a lot of times, once again, you're looking for the same exposures. You just need to make sure that you're not going to trigger any tax issues.
Yeah, definitely. So when it comes down to portfolio analysis, when you're constructing portfolios for your other advisors, updating them, I'd love to learn, what are some of the other things that you look at individually? And then my follow-up question, which we can cover after that, is what are the things that you show clients?
Yeah, so most of my clients usually don't want to get into the nitty-gritty details. So when I was using technology that was producing outputs like that, it was just not a great conversation. It was not a great way to approach it. So for clients, it always comes back to their financial plan, right? That's the roadmap that tells them how to make decisions. And so Money Guide Pro is the software we use for that builds out the plan. And then usually I'll use Riskalyze to make a risk number, because not only is it very easy and very client friendly in terms of like graphical interface, they get it. They get the idea of, 0 to 100, and I'm a 64. And if I don't feel comfortable with being 64, well, Michael, what do you do that's below a 64? And then we can look at something else. So that's on the client facing side. And then on my side, when I'm doing more deep analytics, I like using Koyfin. Of course, I'm using Logically now to kind of use a way to look at my historical track record and how the portfolio has changed over time. Because I don't know how closely a lot of advisors look at their like historical long-term performance. And
awesome. And when we're talking about like metrics, is it usually performance, risk, cost, exposures? What's the stuff that you're looking at the most?
Yeah, so when I'm looking at things very closely, I always start with portfolio. I'm looking at the construction of what's underlying this fund, because in the industry, a lot of times they give names to things that don't always correlate to what you want it to do. Something that's an opportunities fund is usually code word for concentrated, or a focus fund, concentrated again. So I always look at the underlying assets first and then work backwards. How much style drift does it have? Is it an all cap version, or are they focusing on mid cap? Or then I start looking at metrics like cost. What is their cost to run this? What is their historical discount or premium? Those are factors that we want to look at to make sure that it's going to have the ability to be traded very easily for us. And then just overall, how it consolidates together. You could have a best of breed ETF in your portfolio, but if there's overlap, or if it's not complementing the other things in the portfolio, it just isn't going to work. And I've seen this where an advisor uses a balanced fund as a core and put things around it. I kind of do the opposite. I kind of use individual pieces and make sure that there's no gaps.
Got it. Yeah, no, it's interesting you say that, because that's always a big thing that we hear from advisors who are trying to screen the universe of ETFs, and they come to us for the screening tools. They say, well, there's 100 funds that say, they're dividend ETFs, right? But what does that really mean? Or, if it's a tilt, if it's an ETF that has a tilt, like, or smart beta, right? How do you really determine if it meets what it says that in the blurb, the objective of the fund, right?
Exactly. Is it a dividend growth fund? Is it a high yield dividend fund? Is it a sector dividend fund? It's not always clear at first glance.
Yeah, for sure. No, so it's interesting that you said that. So we kind of covered, how you look at the ETF, how you look at portfolios yourself, and then how you share that stuff with clients. Taking it a step back, I guess, and just overall about your business, and especially throughout, this whole pandemic situation, I'm curious to learn a little bit more about how you and your firm have adapted. So, number one, before, were you kind of doing client review meetings all in person? Was it kind of you were more casual, you would go get coffee with your clients, things like that? Were you more traditional, having them come in, handing them paper reports, or were you already kind of doing some of the digital stuff that we're doing, like Zoom right now, with your clients?
No, it's been night and day. In fact, even early on in the pandemic, that first 3 months or so, clients really fought doing things digital. They like coming in, they like sitting down. And even though I'd have my screens with all their data, I rarely print things out. They liked being face to face. So at this point, I am doing a lot more Zoom. Clients have learned the technology. One thing that I've actually noticed is that when I tell the clients they don't have to have their video on, that when they join the room, it's going to start off. Some actually prefer that. They could see me, but I don't need to see them all the time. And that's gotten some people over the hump to make sure that, I don't need to see them in their pajamas. So that's been a big change. The way that we're targeting our marketing has definitely changed. I had our data and analytics department at the credit union run a screen of everyone who had a direct deposit in January, and then everyone in July who was at least 60% below that direct deposit. And that created a list for us to call out, and not even talk about investments, but just ask, is there anything that we can do to help? Is there anything that we can do? Are you being forced into retirement? Are you between jobs? Is there anything that we can do to help? And between my services and what we can offer through the credit union, we've been able to make a positive impact for a lot of lives.
Yeah, that's awesome. And that kind of leads to my question I had about how it works, prospecting new clients to their credit union. Obviously, it seems like with the credit union, you'd probably have some leads, teed up to you in the case that, they're already, banking with the union. But how do you think about like prospecting new clients, both through the credit union and if you are outside?
Yeah. So my business is fairly mature at this point. I've been with the credit union for 11 years, and I was advising with Merrill Lynch before then. I would say a lot of my new clients coming through referrals, a lot of word of mouth. That's the predominantly. But like you said, as a credit union, for my other advisors, having getting referrals from the frontline staff and the phone center is huge. We get probably about 50 to 100 referrals a week of people who need to talk to us, whether they're looking for a better rate on their CD, or they just left the job and they're ready to sit down and do a financial plan. Like I said, you kind of have to be able to deal with everything at a credit union. And that's the good and bad of it. We get a lot of clients, but you have to kind of know everything. You can't just focus on just being an allocator.
Right. Okay. Well,
I mean, so before we started, we were talking about some of those other side projects I've been working on.
Yeah.
The main one is the Credit Union Advisor League. I know we were just talking about the credit union. I'm building out a network and a community for specifically credit union advisors, program managers. There isn't a great resource for collaborating and networking in a space to share best practices. So cuadvisorleague.org is something that I'm working on, along with another advisor, Casey Madsen, to bring that all together. So that's one thing that is making a big impact. At the credit union, we're all about service and making an impact, and putting this together has been great.
That's awesome. Yeah. From being on Twitter and all that, I definitely see the value of advisors being able to, lean on each other and kind of bounce ideas off of each other. So it's awesome and some advisors have specific niches, right? But that's awesome that you're developing something for credit union advisors. And then the other thing we talked about a little bit was gaming, right? And I think it stemmed off from, you listened to one of our episodes with Tim Maloney of Roundhill. I've recently you inspired me from our last chat to actually start streaming a little bit. So this weekend I was streaming COD since I've been playing a bunch throughout COVID. So
very nice. Happy to hear it. Yeah, that's like my last project that I'm working on, investing metagame. And right now it's just a blog, but soon to be Twitch channel and Discord, and a formal bridge between the investing and video gaming communities. So we'll have to have you on as like a guest streamer, it sounds like.
Yeah, that'd be awesome. So I'd like to talk a little bit more about that too. You mentioned last time that you see a lot of parallels between gaming and investing. Could you elaborate on that a little bit more?
Yeah, so there's so many core principles of investing and gaming that go hand in hand, so like cash flow analysis and in CSGO, managing your budget from round to round. You need to be able to make the purchases you need in the rounds that you're playing. Or another example would be any game where you have like mana or elixir. You need to make sure that you're budgeting right so you could play defense and offense and make a push at the right time. And investing is the same way. You have to make sure your buy points and your sell points are going to be at the right time, or if you're dollar cost averaging, you need to be consistent. You can't overweight one month over another. It's going to defeat the purpose. So yeah, there's a lot of things that definitely parallel, and it'd be nice to have a community to kind of bring that all together.
Yeah, definitely. I know I already followed you, and I'm excited to see that. I think it's a great way to get the gaming community interested in, getting a little better literacy, financial literacy, right? I think that would be a huge, an easy way to kind of teach people about investing in personal finance a little bit based off of already, examples that they already know and love, right?
And it was the one of the reasons I started it was I was in the chat on a Twitch channel, and the streamer was asking about Roth IRAs, and the chat was just filled with all this wrong information. And I was like, we need to get this right. We need to put this together and have like a formal community to like actually go through these things, because even esport athletes, professionals, they could come into a lot of money quickly. And as someone who's worked with people who have won the lottery, that money could go quick if you're not allocating it properly. So we need to make sure that we're taking care of everyone in the community as well.
Yeah, so it's interesting that you say that, because I noticed also in terms of like places where people are getting a lot of wrong information, TikTok. There's a lot of people on TikTok that they're like, real estate investors, right? But really what they are is
cash value life insurance.
Yeah. Or pure scam, or almost like some of them are pure scams. And they're on there and they're talking like they know what they're talking about, and it's just wrong information, and yet they go viral, right? And it's funny, like I feel like as advisors, I know there's some compliance loopholes, but I think there's huge opportunity to jump on those channels like Twitch and TikTok and I don't know, maybe Snapchat, and start creating, you know, channels and content that's providing correct and, you know, actual financial literacy to people that are on these channels, right? I think, you know, advisors spend a lot of time on Twitter to push that content out and education, and obviously LinkedIn. I don't know that many that are using Facebook. Are you using Facebook at all?
Only for the Credit Union Advisor League, we use
Okay.
that as a forum. But you know, at some point, maybe we move that over to Slack or Discord or something that's more functional for conversations. But you know, I totally agree with you, and it's kind of twofold. You know, there's obviously a compliance burden for everything we do as advisors, which is, you know, good and bad. But also, a lot of advisors don't want to focus on these communities that don't have huge AUM, at least to start. You know,
Mhm.
it's I could spend my whole day talking to my retired clients and getting referrals from them and building the whole business that way, um, because there's a lot of AUM to manage there. But you know, when it comes down to it, we need to be able to give advice and good advice to everybody. And there definitely are some areas where we're kind of giving a disservice to those people who are going to be doing very well one day. They just aren't right now.
Yeah. No, that's awesome. So I think that pretty much wrapped up everything that I wanted to talk about. So, Michael, thanks again for hopping on the podcast. A lot of great projects that you're working on. Again, if you want to get in touch with Michael as part of SoCal Wealth Management, you can reach out to him at.
Well, I have LinkedIn for the credit union, for the CU Advisor League. That's .com, and investingmetagame.com as well. So if you're a gaming, credit union, or wealth management, I got you covered.
Awesome. Very diverse things that you're working on, but all very awesome, and looking forward to following you more on that. So thanks for coming on today.
Oh, thanks so much.
And for those who are listening, again, if you're listening on a podcast platform, all these videos are now available on YouTube as well. So you can check out our page logically. Just search it on YouTube and all the videos will be there, as well as some other videos of us showing how to use the platform, best use cases, things like that. Thanks again for listening to Speaking Logically, and hope to hear you guys on next week.